Hi, today I'm going to teach you more about the topic of hedging. I will go into the definition, its significance in managing risk, and the common hedging strategies that traders and investors use. And knowing more about hedging is extremely important because limiting your downside risk is just as important as trying to maximize your upside. Because if you lose 50%, you need to earn 100% to make it back. So learning how to limit downside is very important. And it doesn't really matter whether you do this in a professional setting with millions of dollars at stake or just for your personal portfolio, it's relevant to know about hedging either way. And you might be asking yourself, what exactly is hedging? You might have heard of the term, but you don't really know what it is. And essentially, hedging is a strategy, it's an investment strategy that's aimed at reducing downside risk. And you do that by taking an opposite position in a related asset. So, for example, you go long on gold, but you short silver, or you go long on a tech company stock, but you short a tech index. So you profit when your long position increases in value, but you limit your downside if the opposite happens because you've allocated some money towards a short position. And I've already touched on this a little bit, but why is hedging so important in managing risk? And it's very simple, essentially. Losing money is very simple. Making it back is very difficult. So you really need to think of a way to prevent losing too much money because it's not easy to make up for it. As I said before, if you lose 50%, you need to make 100% to break even. If you lose 20%, you need to earn 25% to break even. So the more you lose, the harder it becomes to compensate for it. And hedging can really help you limit that downside by either profiting from a bearish market move, or it can ensure you from losing even more if you're already in a losing position but not willing to sell yet. And that's where we get into the most important part of this video. What are the most common hedging strategies? And they go all the way from very simple ones to extremely complex ones. And one of the simplest hedging strategies is one that most people already know about, diversification. By spreading your investments, you reduce your risk, so that could be considered a hedge. There's one condition though, your positions, your assets cannot be perfectly correlated to each other, but otherwise you're completely fine because when one asset does well, another one does a little bit less well. So that really reduces the volatility of your portfolio, and volatility equals risk. But when most people think about hedging, they think about financial instruments like options and futures. Options are contracts that give you the right to buy or sell a certain asset for a certain price at a certain point in the future. Options to buy are called calls. Options to sell are called puts. And there are two main kinds of options, American options and European options. American options can be exercised at any date leading up to the expiration date, while European options can only be exercised on the date of expiration. So that's an important distinction to note. And futures are contracts to buy or sell a certain asset for a certain price at a certain time in the future. So those are more structured as obligations. And they're called leverage derivatives, which means that you can control more money than you actually have with a contract. So, for example, if the notional value of an oil contract is $60,000, you would only need about $10,000 of margin in your account to actually enter a position in with one contract. So let's go to a few examples. And companies who deal with commodities a lot often engage in hedging. Think about a coffee company for cocoa beans or an airline for jet fuel. So let's suppose you're an airline and jet fuel at the moment is $5 a gallon, which is high because a quarter ago it was $4.50. You don't want jet fuel to increase even further because that would really cost you a lot of money. So what you can do is you can buy a number of futures contracts for jet fuel with an expiration date of, say, 1 year in the future. And what that means is that at any point in the next year, you can buy jet fuel for $5 a gallon, but you immediately sell it for the current market price at that point, which means that if jet fuel is up by $1 compared to now, you have $1 in profit. If it's down $1 compared to now, you lose $1. But you've essentially fixed the cost of jet fuel for the next year. And another example with options would be Suppose you've bought 100 shares of XYZ stock for $100 a share, and a few months later, the price has dropped to $80 a share. But you're not willing to sell it yet. Maybe you don't want to incur a taxable event, or maybe you think the price is still going to increase. What you can do is you can use what they call a protective put strategy to hedge this. And what this is essentially is you buy one put contract that's usually for 100 shares with a strike price of $75 um, and an expiration date, for example, 1 year in the future. And what that means is during the next year, you can buy 100 shares against the current market price, and then you can sell it against your strike price. So what happens is if the price of the stock starts to drop below $75, you make up for it through your short position. Um, so you limit your downside. And if the price happens to increase, you just choose to not exercise the option. Um, and the premium that you've paid for the option is the only thing you can really lose. So hedging is a strategy that you can use to limit your downside, and you can use derivatives like options and futures to do so. However, apart from speculation, retail investors generally don't use options and futures a lot, to hedge their positions with, because they can be A, quite complex, and B, a lot of retail traders usually invest in highly diversified ETFs that don't really require an additional layer of hedging, but it's still relevant to know something about, especially when you have a finance career. So I hope you learned something about hedging in this video. And on that note, I would like to end. So thank you for watching, and see you next week. Bye.